This is Spencer with Numbers Up Finance. Today I wanted to do a quick market outlook for Thursday, December 27th. And so to start out this video, I'm gonna do let's first talk about what happened the past couple days. So the end of last week and Christmas Eve, Monday earlier this week were very interesting days. It's post Fed raising the interest rates, and what we got was a mix of panic selling and waterfall selling. They're both one and the same. And this did significant technical damage to the charts. What it did is it brought it down about another 6 to 8% depending on which index you look at. And this is very significant because what it did is it foiled the bullish divergences that we were getting where the momentum was pointing upwards. What happened now is now we're significantly below that, both on, well, not on the RSI, but on the MACD, which is usually the more clear indication of a divergence. And so what that means going forward is that I'm no longer expecting a reversal, which is what those divergences generally indicate. But that doesn't mean that I'm not expecting more upside, and we'll get to that in a moment. So looking at the 2-year daily chart for SPY, we can see that today we had a ginormous green candlestick. It was about 6%, I do believe. 5%, pardon me. It was 6% on the Qs. And so this isn't necessarily a buy signal, to be exact. We've seen previously before on the indexes, when we have these sharp sell-offs, it's very common that we get a very large snapback. We did here earlier the year where we have a huge sell-off, and then we have a nice big green candlestick. And while this it was an indicator that it was the end of that sharp sell-off, we still had 2 red days after that brought us down before we finally started to climb back up. A couple months later, you see a similar thing, not quite as quick moving of a market, but you see prolonged downtrend, and then you get a nice big green candlestick, but we have more selling a couple days after, but we started to make higher highs after that. And so what that means is, while today was a very good day for the bulls, does not mean necessarily that the next couple of days, Thursday and Friday that is, are going to be green. And so currently I'm not positioned long, although I would venture to guess that we're going to see the price end up testing either this resistance support area or even the moving averages possibly before we see lower lows. But again, it's all dynamic. You have to be able to read what the charts give you and make decisions on the run. And so looking back, there's a couple of things that make me say that this snapback is going to have some significance to it. I already mentioned that I'm not expecting a reversal. While we had these bullish divergences in play, I was expecting us to really shoot back up. We were right around this area, and I was expecting us to maybe even come up and test this very strong support resistance area up at about 280. I certainly do not expect us to come up and test that, at least not in the near-term future, meaning the next couple of weeks to month or so. But on many of the major indexes, we came down to a fairly significant resistance area. Let me show you on SPY. Let's go back about 3 years. That should show it. Yeah, so you can see there's a lot of reactions right around this 230 zone. We didn't quite come back down to it, but that's fairly normal for testing supports that were created a long time ago. Let's go over to the QQQ chart real quick. QQQ came right down to about a year and a half ago. There are many reactions right around this price level. It's about 143 that we came down and tested. And actually on QQQ, this is pretty significant, but we ended up closing above what was the previous year low. And so I would expect that going forward to hold, at least on QQQ. It does not line up perfectly with SPY. I'll go back to that real quick. We're actually pretty far below, not pretty far, but relatively low. A little bit lower than the previous year low. And so on the daily chart, I'm expecting a couple percent more. Again, I already mentioned that I'm not long right now. My ideal situation would be the next 2 days to end the week are a bit of a sell-off, because that would be an objective point where I could go long and set a stop loss below this previous low. So let me lay that out for you. What I'm hoping is that the next couple of days, this was kind of an impulsive green candlestick up, so hopefully we come back down a little bit around this region here, lose a couple percentage points on the indexes, And then I would be looking for a bigger a jump back up where I could set a nice tight stop loss at about 2%, give or take a couple percent, and have a lot of room for upside. It's all about increasing your expected value when you're doing trades. And so real quick, I just want to get into some of the individual market sectors. This is one of the big reasons why I'm long for the next couple of week or two, depending on how the markets play out. My convictions aren't terribly strong, but right now I'm leaning more towards the long side than I am the short side at this point. But let's look at so the 4 sectors that I'm going to show you are the four that make up about 60% of the total market. And so if you expect those 4 to be green over the next couple of weeks, that means that you're also very bullish for the market. And what's significant about these is that all 4 of them came down right at support or right around a very significant support area. We can see with the financial sector that a couple years ago we had this very, very, very strong support zone at about a little bit below 23. And we did undercut that a little bit, but I already mentioned this, and that's pretty normal when you're backtesting a support from more than a year ago. Moving on, let's go to XLK. This is technology. Now, technology, this one will have a much greater impact on QQQ. QQQ is much more, I don't have the exact numbers, but it's much more technology dependent than SPY is. But you can see XLK came right down, right onto this support area at about $58. It's not a tremendously strong support, but you can see there's quite a few reactions right around this period of a couple months, about a year ago, a little bit more than a year ago, that is. And so I still see more upside for XLK. Moving on, XLV. This is the healthcare ETF. Healthcare sector, pardon me, it is an ETF, but you can see we're testing these lows from about a year ago, right in between that nice tight zone between 80 and 81.5. Well, we tested it right in between that zone. Now we've since spiked up, and there is this area that it could act as a resistance. But with these volatile markets, you're looking for one big zone for a reversal. You're not reading too much into these in between levels for support or for resistance, that is. And then the very last one that I have is XLY. This is consumer discretionary, and do not want to zoom in there. But you can see again a very well defined support resistance line. Goes back a couple years, and we tested it right on the spot. We undercut it a little bit, but with the volatile market, that's perfectly normal. And so again, these 4 combined, these 4 ETFs that I showed you, make up 60% plus of the market. And so it tells me a lot that they all came down to very significant price levels and are now moving up. The very last thing that I wanted to go over in this market wrap is the VIX, which is the volatility index of the market. And for those of you that don't know, VIX is just a measure of the puts to calls being purchased in the market. So it's basically an indication of how bullish or bearish the sentiment is. And there's not much to show here, but from the previous year highs on VIX, where volatility was super high for that first pull down that we had earlier this year, you can see the bodies of the candlesticks. We had 2 close right at this level around 37.50, sorry. And we basically came up and tested that. We're, a percentage point or 2 short of it, so it's maybe a little bit more. But in the grand scheme of things, we're pretty darn close to that support, and so this kind of significant red candlestick down would lead me to believe that we're going to be moving farther downwards before we test this again. Now again, next couple of days, a good part of me is expecting that we're going to have some downside. I don't like to put percentages on it, but I would say maybe a 60-65% chance that we have a couple red days, but I don't expect them to be very significant. And I'm certainly expecting the next 8% move in the market to be bullish rather than bearish. I'm just waiting for a very good time to enter. And so that's it. I'll leave you there with that. I hope you guys enjoyed. Be sure to leave a like, comment, and subscribe if you had any comments or criticism for us. It's greatly appreciated. Make sure you keep your numbers up, and I hope you all enjoy your new year.